Well, the Liberals served up their fall economic statement, and it's a doozy. Unsurprisingly, there's definitely some downsides, but surprisingly, maybe there are actually some positives. One, that we thought it could have been much worse than it actually was. So we're gonna walk through what some of the duds and the studs were in the announcement and explain to you the specifics of what we think this could mean moving forward for both the mortgage and the real estate world. Now, unsurprisingly, the federal government is pushing hard, like every government right now, on everything housing. And it is the primary focus, or one of their primary focuses, that they're trying to, see if they can hang on by. But we're gonna leave it up to you to let us know what your thoughts are on these decisions and the specifics of how you think the housing economy might be impacted. And if you stay to the end of the video, of course, I'm gonna give you my feelings and thoughts on the changes that occurred today and what I think this will mean for the housing market moving forward. My name is Alex McFadyen, your resident mortgage professional and expert owner here at Flow Mortgage Co. And if you're liking this content, or if you like this video by the end, just go ahead and click that like button. I know most people don't like hearing that, but it helps us to get more eyes on the channel and help more people. So let's get into it, shall we? There were a number of different initiatives that were announced today, and I'm gonna read through these as well as provide you with some insights based on a few of the notes and my overall thoughts and feelings on the matter. Now, the first and very most important consideration is, well, we've heard about this big old word deficit, the federal budget deficit, and it keeps getting deeper and deeper and deeper as they dig themselves into a trench. And so the biggest question is, we're digging ourselves into this deficit, how do we get out? I don't know, but I guess some magical occurrence will happen and it'll put us into a better position. Let's talk about this specific breakdown. Now, despite all the warnings, we're looking at spending about $20.8 billion of new money on these new initiatives, which is interesting. And I guess the upside there is that we could have spent a lot more money on these types of initiatives, right? Let's get into the juicy stuff. One of the biggest announcements from the actual overall charter was the Canadian Mortgage Charter. And I'm gonna be blunt with you. During this Canadian Mortgage Charter, this was just regurgitated things that are, in most cases, already happening with a few exceptions, but they've been set as guidelines moving forward for most of the banks. I'll give you my grade towards the end of this, but let's just walk through exactly what this is. First and foremost, you Canadians can expect allowing temporary extensions of amortization periods with mortgage holders at risk. Now, I don't know about you, but my experience has been that most banks are actually already allowing this, so I guess they're mandating it. Number two, waiving fees and costs that would have otherwise been charged for relief measures. Now, this is positive. We've seen that most banks are actually willing to do this, but not all of them. And so it's nice to see that that's written down in stone, so they're not taking advantage of people who can't obviously make these payments. Number three, not requiring insured mortgage holders to requalify under the stress test when they're transferring over. Now, let's talk about this for a second, because it was actually announced and uncovered just a few weeks ago that this is actually the case. So you can essentially switch if you have an insured mortgage where you bought it with less than 20% down, and you can move over to another lender now and not have to requalify. What this actually does is it actually opens up more options and it makes it more competitive now for borrowers to be able to transfer over if they can't qualify at those higher interest rates, because one way or another, they're going to keep their mortgage because they could renew with their existing lender. So we might as well provide them with options. The interesting thing about this is this was already announced. So this is really just a regurgitation of what we already know at this point right now. Nonetheless, a good thing. A key note on this is they didn't actually open it up for uninsured borrowers. So for a large portion of the population, they have an uninsured mortgage, which is essentially a more than 20% down purchase, over a 30-year amortization, a refinance, a rental property. And so if you're in those boots, well, you're screwed, no changes. You still have to requalify at the stress tested rates. Number four, contacting homeowners 4 to 6 months in advance of the mortgage renewal. In my experience, most banks actually do this. I guess they have to be more aggressive. I don't know. Number five, giving homeowners at risk the ability to make lump sum payments to avoid any negative amortizations or sell their principal without any prepayment penalties. The only real difference here is the penalty part. At the end of the day, if they have to sell, they're saying that you don't have to pay off that, 3-month interest penalty. But at the end of the day, most banks will provide people with the ability to do lump sums. The challenge has been the communication around it has been poor, because passing down the pipe, different parts of the banks have provided people with different types of options, not understanding exactly what they could really do. So essentially, it's just a reminder on what the options really are, and then a removal of the penalty. Number six, not charging interest on interest in the event that the mortgage relief measures result in a temporary period of negative amortization. So essentially, they cannot charge interest on interest. So those going into the negative amortization territory, well, you can breathe a sigh of relief in the sense that there's no more interest charged on interest. Really, at the end of the day, my thoughts on this is nothing new, but I guess it's good because they didn't make any negative changes. So we're gonna roll forward with that. Next big one, short-term rental restrictions. Now this is very controversial, and depending on which side you lean, there's nobody in the middle. You either love it or you hate it. Short and sweet. If you're doing a short-term rental property outside of the jurisdiction, so if your province says you can't do short-term rentals unless it's your primary residence, so if it's in your primary residence, that's fine. If it's not your primary residence, you can no longer claim the expenses. So as you know, typically you can claim rental expenses like interest, strata fees, taxes, a variety of different things. You can claim this to reduce the amount of income taxes you pay. That's not an option anymore, and the federal government is saying no to that. I think this is completely short-sighted, and whether you're for or you're against, you shouldn't tell people what they can do with their homes and just arbitrarily take this away. I think this is going to absolutely decimate a lot of the tourism in many different towns, and to do this carte blanche, in my opinion, is a poor move and does nothing really positive other than just to mandate what people can or cannot do. It feels very Big Brother-esque, and for me, I'm not a big fan of it. CMHC. CMHC spends are up, and they've seen a lot of applications for multi-unit. You might have heard of CMHC's multi-unit lending programs that are available. They've become very popular in the investor crowd, and ultimately, this is a good sign because they're gonna spend more money on these programs to help build more multi-unit properties. For any of you multifamily investors or those who are considering it, this is really, really good news because you are seeing a little bit more of an increase. We need that money because the applications can take like 6 months to get approved. And so this should hopefully shortcut that back down. So essentially the government is committed to buying a number of government-backed or Canadian mortgage bonds, which is supposed to, for the most part, reduce the actual funding costs, therefore reducing overall spreads, which realistically should reduce costs and provide a little bit better of an ecosystem for lending. This one gets a little bit complicated, but at the end of the day, the nature of this is to provide a little bit more liquidity and less disruption to important mortgage funding. In short, we think this is required, and so this is a good move by the government. Moving forward, other considerations. They're going to be providing more financing for rental developers. So they'll boost low-cost developer funding by injecting another $15 billion into this apartment construction fund. This is really good news, and we want to see, obviously, programs like this continue forward to create housing where it's required. This is something that's long overdue for the purposes of obviously ensuring that there is enough property and enough housing for people to live in. Essentially, at the end of the day, the government is predicting that we do see unemployment go up over the course of the next year to 2 years. In fact, they're expecting almost a 1% increase into 2024, which ultimately would be a good sign if you're someone that's looking for interest rates to drop or decline. There's a few things that they're looking for before they start dropping interest rates. One of those is unemployment around the 6.5% range. And the second is obviously seeing inflation below the 3% target. So all this indicates that we'll start to see interest rates decline by the end of next year. Now, if you're still with me, my overall thoughts on today's federal budget is, well, we have a bigger issue in hand, and that bigger issue is federal spending is absolutely out of control. I think a few of the changes today were helpful in terms of adding rental housing and multi-unit housing, which is great. Some were non-impactful, which is the mortgage changes really didn't help anything or do anything other than what it has already been going on. And then a few of the changes feel very, very, very overlordish, like these short-term rental ones, and have no real impact. Time will tell whether or not these deficits get worse, but based on the track that they're on right now, it looks like we're digging a really, really big hole. So the question that I have for you is, how do you feel about the changes today? Let me know in the comments below. And of course, if you like these types of conversations, let me know as well, and hit that subscribe button so we can give you a little bit more of that going forward.